In today's video, I'm going to run through a rough scenario of what it would take to qualify for a $500,000 house. It's been a while since we've done one of these videos, so we're going to run through the scenario. That way you can see how much income you would need in order to qualify for this type of property. And if you want us to do a specific scenario for you, you can always comment below, or you can hit the description. There's my email, and I'd be happy to do a custom scenario for you. And maybe we even feature it on our channel the next time we do a video. Thanks for tuning in. My name is Sean Uyehara. I'm an area manager with Geneva Financial, and I created my YouTube channel to help you get your mortgage right. We've been helping customers over the last 15 plus years in the mortgage industry. So a lot of what I share with you are tips and strategies that help our clients be successful. And again, there's more information below in the description to help you, whether you're looking at purchasing, refinancing, or if you need a pre-approval, we can certainly help you out and get you into your new house. So let's hop right in. We're going to run through this scenario. I'm going to take a $500,000 house. And we're just going to do some simple math here, and we're going to go with a 20% down payment. So in the lending world, we always look at percentages. So this would be our 20% down payment, which would mean we're at an 80% loan to value. When you look at qualifying someone for a mortgage, we're always looking at the LTV to determine where that risk pricing will be based off of. So in this case, the age-old myth of putting 20% down, we're just going to use it for the ease of math in this video. So our loan amount is going to be $400,000, right? So our down payment is $100K. So if our loan amount is $400,000, remember that's what the mortgage payment is going to be based off of. And another thing that I always hear folks talking about, or in the industry, we use the term points. So points is just up 1%. Now, when you're buying points or paying points, it's always going to be based off of the loan amount. So in this case, let's say if you're paying 1 point to buy your rate down, that would be an additional $4,000 on top of all your additional closing costs that you have. This is why it's always important that when you're talking to a lender, you get what they quote you in writing, not just over the phone, because people can be slick and just tell you what you want to hear to get your application in. And then in the 11th hour, they flip it on you and you had no idea what you were paying for. So make sure if you're getting quotes or you're doing anything, get it up front and make sure you do it on the same day. The market's been so volatile lately. We've seen so many rate changes multiple times throughout the day. So what someone told you 2 days ago could be totally irrelevant with where interest rates are today. So we're looking at a $400,000 loan, and we're just going to ballpark this interest rate, and let's just say it's 7.5%. Could be lower, could be higher, but just for the sake of the video, I'm just using 7.5%. It's not based on anything else. So our principal and interest payment is going to be $2,797 a month. Now remember, your mortgage payment is based off of your principal and interest payment. You also have your taxes and your insurance, as well as for most parts of the country, there may be an HOA payment as well. So make sure, again, when you are going through the qualification process with your lender, they are factoring in all of these numbers. If you're buying in different parts of the country, make sure that they are well aware of where you are buying. For example, if you're buying in Texas, Texas is notorious for having higher property taxes. I once had a realtor in Hawaii that was looking to buy property in Texas, and she was helping her client out, and she had no idea that the property taxes were that high. So all her numbers that she was basing on her investments to help her clients were all inaccurate. And unfortunately, I had to break her the news, but thank goodness it was before they went into contract on any of these properties. So again, just make sure that your agent, your lender is fully versed and knowledgeable about the market you're buying in, because little mistakes like that can cost you thousands of dollars down the road. And who knows, maybe you even buy a property that doesn't even make sense for you, and good luck trying to sell it after that. So on a $500,000 house, we have a $2,797 monthly principal and interest payment. We have our taxes, and let's just say that's going to run us, call it $400 a month. You have your homeowner's insurance. Homeowner's insurance, let's just say that's $75 a month. We're not going to have any mortgage insurance because obviously we're putting 20% down. But remember, you don't always have to put 20% down. And the fact that you put less than 20% down on a conventional mortgage, there are ways that you can buy out your mortgage insurance, or your lender can show you other strategies on how to eliminate it. So don't get so dead set on the fact that you have to put the 20% down. If you've got 10% down, have your lender show you those options. It may not be as bad as you think. And let's just say for this property, we have an HOA of $50 a month. So now we're going to add all this up and see what our total monthly payment is. So we're looking at a total monthly payment of $3,322. So now this is the number that your mortgage lender is going to use to qualify you for your loan. Now, what we also have to take into account is any other consumer debt that you may have on your credit report. Now, this is another piece where a lot of folks get this number wrong. So when a lender's qualifying you for your mortgage, remember, all we are looking at is your minimum payments on that credit report. So if you've got let's say a credit card with a $5,000 balance, we don't necessarily care about what the balance is. All we're looking at is the monthly minimum payment. And let's just say it's $50. So that $50 gets assessed to you towards your debt to income ratio. So again, if you're trying to do this at home, make sure that you're not taking into account the total balance. We just want to know what the monthly minimum is. So let's say for this person, they've got a car payment of, let's say, $500 a month. Let's say we've got some student loan payments of $200 a month. And let's say we've got some credit cards, and let's also say that's $200 a month. Any other debt that shows up on your credit report, we have to factor that in. So if you have installment loans, payday loans, anything else that shows up on your credit, if you went to Lowe's or Home Depot and you got a 0% credit card, we still have to factor in some sort of payment for you. Make sure you, again, know what these numbers are. So again, let's factor this in. We're going to add another $900 a month in revolving debt to our total, brings us to $4,222 a month. Now, an easy number of what we're looking at in mortgage financing is you really want to keep your debt to income ratio under 45%. Now, in some instances, you can exceed that amount, but the one thing I want to remind you of is that when a lender is qualifying you for a loan, we are looking at your gross monthly income, right? So this is before your taxes come out. This is before if you pay child support comes out. This is before any other contributions to an IRA, a 401k, any of that stuff is taken into account. We are looking at your gross monthly income. So even though we're looking at 45%, after your take home pay, that number can significantly jump up. So this is where you really want to not push the limit when it comes to your qualifications, even though most people love doing that because they want to buy the more expensive house. But as a lender, I can tell you, this is where a lot of people get in trouble. Make sure that when you're running through this scenario with your lender, you understand what your DTI is or your debt to income ratio. So that way you are not putting yourself into a worse off position. Now, all we're going to do is just divide this by 0.45%. This is then going to give us $9,382 a month in income. So if you wanted to buy a $500,000 house and you could afford to put 20% down, and you had somewhere in the neighborhood of $900 worth of revolving debt, you would need about $9,300 a month in income to be able to qualify for this type of property. Now, there's a lot of factors that can change here. You could have somebody with less debt. You could have somebody putting maybe 10% down instead of 20% down. And obviously the interest rate plays a factor as well. So just as a rough ballpark in this scenario, if you're buying a $500,000 house, you probably need somewhere in the neighborhood of $9,300 a month, or you're looking at an annual income of about $112,000. So easy math for you to go ahead and follow. You can do this scenario yourself, or if you'd like myself or my team to actually give you an idea of how much income or what you could qualify for, you can shoot me an email in the description below. I'd be happy to customize a plan for you. Thanks for watching, and I'll see you on the next one.